Hello, everybody. Welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd, 2024, of course, at the Vancouver Convention Center. Stay tuned for tickets. And today's guest is an independent asset manager specializing in ETFs and the founder and CEO of GraniteShares. It's William Rhind. Welcome to the VRIC channel.
Thank you, Jesse. Thank you for having me. Pleasure.
Thank you for being here. The pleasure is all ours. And I want to get started with your broad economic outlook. I've talked to a lot of people when it comes to the US economy as well as the global economy. I'm hearing a lot of different opinions. I'm hearing, we're going to be headed towards stagflation. We're going to see a deflationary depression. We're going to see a mild recession. It's going to be a soft landing. There's all sorts of experts giving all sorts of predictions. So I'm wondering where you stand on the issue when it comes to the economy here in 2023.
So I'm of the view, Jesse, that at the moment, things are pretty good. And from my perspective, here in the US, I think that the economy is in relatively good shape. Sure, there are some issues, particularly in the real estate market. And I think, anything directly impacted by the tightening of credit conditions that we've seen, going from a zero interest rate environment to 5% where we are. However, what's interesting is that the market has been incredibly resilient to that. And I think it's very difficult to have a situation where we are about to lurch into recession or we are in a recession with the job market so strong as it is. And indeed, that's never happened in the past. So from my perspective, I think at the moment, things are actually pretty good. Now, that's not to say that we couldn't go into a recession if there's a policy mistake, from the Federal Reserve, for example, in terms of raising rates from here too high. But I think at the moment, the soft landing or indeed the sort of, economic conditions are okay or better than people expect, I think is where I am at the moment.
So what about the fact that when it comes to some of the indices like the S&P 500 and the NASDAQ, there seems to be a very small percentage that are the mega cap tech companies that seem to be holding those indexes up. Do you think that's any cause for concern? Because I believe if you take those out, the S&P, for example, is pretty much flat to slightly down for the year. How much of an impact do you think that market cap weighting has, and should people be concerned if those particular companies maybe start to head for a correction?
It's a really interesting question because those companies, they are the largest companies in the index. So therefore, because they have the largest weight, they have the largest impact on the market more broadly. Clearly, they were the main reason why the indices dropped so much last year. Was because in a rising interest rate environment, that repricing of those large tech companies was, in many ways, the main contributor to performance last year. The fact that those companies have come back this year is also the main contributor to performance this year. But I want to talk about maybe just going back to 2021 and the sort of, let's call it the 5 years before that. And there, clearly, you can see that those companies outperformed the entire market. And depending on what time period you looked at, there were probably many time periods, if not the whole time period, that you would have looked at and said, hang on a minute, if you strip those companies, out of the index, then the index is flat. And that, again, was true. And even at the time when I think everybody believed, or everybody rightly believed, that we were in a bull market for stocks. And so that gave rise, obviously, to the acronym, the FANG stocks, and these acronyms that describe the largest tech companies, certainly in the market. And I think the acronyms were really there to drive or denote the importance of those companies and how big they've become and how much they have influence, not just on their respective sectors, but on the entire stock market itself. So absolutely, that is just the way the way things are at the moment, is that, in a market capitalization weighted index, the largest companies drive the performance. And because those companies are so large, love them or hate them, that is going to drive performance of the index. So this year, that's where the performance is at. Last year, they were the biggest contributors to the negative performance.
So I want to get your thoughts on commodities here as well, and where you see commodities, because I've heard a lot of talk of a commodity super cycle for the next decade, that there's been record underinvestment in a lot of different commodities across the board, record low levels of capex, which somebody like Tavi Costa has been pointing out. And they see a lot of experts in the commodity space are seeing kind of a reversal between big tech and real assets. So I was wondering if you see the same thing. I know that your ETF company also invests in big name tech stocks, which I definitely want to get to later. But I'm wondering how you see commodities specifically performing, maybe in the short term, and maybe if you could give us your longer term outlook over the course of the 2020s here.
Well, I mean, I'm certainly in that camp of saying that, I think commodities are in a long-term bull cycle, maybe even a super cycle. And, my thesis on that is largely driven by, just to expand on those points, which I totally agree with, but it's more about the energy transition. So transitioning from a world in which we're dominated by fossil fuels to a world which is much more sustainable and is decarbonized, perhaps obviously not entirely, but certainly decarbonized from where we are today. And that transition cannot happen without commodities. And clearly, I think the nuance in that story, if you will, is that's not a rising tide that floats or lifts all boats. That is certainly a rising tide that benefits some commodities, so clearly metals, just to talk about one particular sector, versus something like oil. But it is a rising tide, and that is something that is really at the highest levels of policy making in pretty much every major country around the world. So yes, I think fundamentally commodities are in a good spot. The reason why commodities are not performing that well as of right now largely is about China. I mean, yes, there's a recessionary narrative in the US and in Western markets that is affecting commodity prices. That is absolutely true. But I think the biggest story is the Chinese economy, and whether the Chinese economy is going to go into a recession or whether they're going to be able to stimulate their way out. As I'm sure your viewers know, that the property market has been in some trouble there. China is experiencing some growth issues around that. And the question is really, are they going to stimulate to try and rescue the property market and therefore put a floor under growth, essentially? And that, given they're the biggest consumer of commodities in the world, is really the key factor for commodities right now.
Let's talk about the precious metals. Some people view them as commodities. Some people view them as monetary metals. How do you see them positioned? Because obviously we've seen gold touching all-time highs this year. Silver, definitely not so much. So I've heard a lot of talk that silver is much more undervalued. However, I've also heard some people mention that silver could be becoming more of an industrial commodity as opposed to a monetary metal. So what's your view on both gold and silver and how you see them performing up ahead?
Well, I think the metals are in good position. So particularly gold and silver, they're largely benefiting from the environment that we have. And just to think for a second, take a step back and say, well, in a world where both gold and silver, as we know, they're non-yielding assets, and in a world where we've just gone from zero interest rates to the highest rates that we've had in decades, and gold can, touch near all-time high, that's a pretty extraordinary feat for that to happen. I think that tells you that something is not quite right in the world. And the reason why people are buying gold at the moment is because really fundamental factors. Number one, inflation. People are still worried about inflation. Number two, interest rates and the trajectory of interest rates, which the market now firmly believes is down. And third, the most important thing from my mind is that we've had a situation for the last few years where the US dollar has been incredibly strong. And again, on the back of expectations of rate tightening, but that has now rolled over. And I think that the dollar is, and if the dollar is a big if, but I do believe that the dollar is now in a secular downtrend, that will benefit gold, that will benefit silver, and indeed non-dollar investments, and look at the performance of emerging markets. I mean, I've talked to most managers. We're not in emerging markets, but most managers look to markets like the emerging economies and even in markets like Europe as sort of top picks for this year. And one of the main reasons is just simply the fact that the dollar, they believe, will fall vis-a-vis these other countries on a relative basis, and therefore, buying exposure to emerging markets, it's ultimately the same thing we're talking about with gold, is that as a hedge against a falling dollar, people are looking to buy gold, and also, clearly worried about the prospects of recession or a policy mistake here, and wisely are adding gold to the portfolio as a hedge against, something, if something were to happen, a dislocation.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Talk about the main drivers you're seeing when it comes to the dollar potentially losing value, because we've heard a lot of hyperbolic talk out there about the BRICS nations and how they're going to create a new gold-backed currency or a commodities-backed currency. And we're also seeing that certain nations are starting to trade, although it's been very, very small. We have seen a few trades being done. I think France and China did an LNG trade in yuan. We've seen a few other countries trading for energy outside the dollar. Is that a significant development in your opinion? And what are the real factors you're seeing behind a potential decline in the value of the US dollar?
Well, that is a real development, and it's not anymore. It's not just sort of fantasy. That is actually happening, and when I say happening, it is a fact that other countries around the world will trade goods and services, or are starting to trade goods and services increasingly in currencies other than the US dollar. So the Chinese, obviously, but some of the so-called BRIC countries, the Brazil, Russia, India, and China, are starting to open up currency lines, between the respective countries and trading goods and services in, currencies other than the dollar. So less demand for the dollar clearly means that, all things being equal, the dollar should fall. And I think this is a longer term trend, as we see, the rise of China, particularly to arguably being the strongest economy in the world, and really trying to dictate more trade on its own terms as opposed to using the dollar. But shorter term, it's about real interest rates, which is a function of the dollar, the interest rate, and inflation rate. And so real interest rates have a very strong correlation to gold. In other words, if real interest rates are rising, and that's inflation and the nominal interest rate, then gold prices typically suffer. If real interest rates are falling, gold prices typically benefit. And that's the environment we're in now. We have both inflation coming down, and we have the expectation of interest rates coming down. So interest rate expectations coming down. The real interest rates coming down, that's benefiting gold, and that's the real driver at the moment. But yes, longer term, I agree with you that there are some super macro developments that I think will cause there to be less demand for dollars over time, and that's purely just a function of trading partners and other alternative countries, alliances around the world relying more on their own currencies than the dollar.
I'd like to get your thoughts on platinum, because it's a commodity that is not often discussed. In fact, most people I speak to about platinum, they either dismiss it outright or they refer to it as kind of more of a wild speculation. I know that you have a physically backed platinum ETF at GraniteShares. So talk to us about your thesis when it comes to platinum.
Well, platinum is really, you could go as far as to say it's probably the most interesting story this year in commodities. And let's start with the basics. So platinum is 30 times rarer than gold. It's a much, much smaller market. It comes from South Africa predominantly. And it's used for the most part in the auto industry, in catalytic converters to clean the emissions on vehicles. Now, this year, for numerous different factors, but the World Platinum Investment Council, for example, is predicting a deficit in the market of up to 1 million ounces. So huge deficit, the largest deficit I've seen really, I think, since before the financial crisis. And that means that we have way more demand for platinum than we have supply. And when we think about the drivers of demand, is that the main demand for platinum comes from the auto industry. Now, the auto industry is still playing catch up from where we were in COVID. So in other words, we expect more cars to be sold this year, and then the growth obviously in that market, so more demand for catalytic converters. Now, the other interesting thing is that platinum, as your viewers will probably know, has a sister metal or a cousin, depending on how you look at it, which is palladium. And palladium is also used in catalytic converters. Primarily, palladium is used in the catalytic converters that you find on gasoline engine vehicles, as opposed to diesel, where you find more platinum. Now, price of palladium still trades about $300 more than an ounce of platinum today, but it has been a lot higher, indeed up to $1,200 or so in terms of an ounce of palladium versus platinum. And the majority of palladium comes from Russia. So what's happening is really a twofold effect. One, car manufacturers are starting to switch from palladium to platinum because clearly they can be substituted one for one. So therefore, why not get the cheaper metal into your supply chain? And so car manufacturers are starting to switch their demand from palladium in favor of platinum. The other thing is, given that majority of palladium is coming from Russia, you have a lot of companies looking to get Russia out of their supply chain. Now, we all know why that is, a combination of clearly the war in Ukraine and all the sanctions, etc. But from a moral or emotional perspective as well, people don't want to be seen to be taking metal from Russia. And so therefore, that will lead to more demand for platinum. The last thing, which is again tying back to my earlier point about the super cycle and the energy transition, is when we talk about fuels, next generation fuels, and what might be the fuel sources, drivers of the future. We're obviously talking about batteries and all the different types of batteries that are used for anything from electric cars to all sorts of personal devices. But we also have to talk about hydrogen as another fuel source that is very much in the development plan. If you look at the Inflation Reduction Act, for example, in the United States, the amount of money that's been allocated to hydrogen infrastructure, et cetera, is astonishing. And again, this is not just about the United States. This is happening around the world. We have major oil companies like BP, et cetera, developing hydrogen as alternative fuels as well. And for hydrogen, we need platinum. Again, for the hydrogen fuel cell that powers the vehicle, the fuel cells need platinum for the catalyst as well. And then if we're talking about green hydrogen, which is hydrogen that is developed from purely sustainable sources, i.e. wind, solar, etc. And again, we use platinum in that process. So I think it's a really exciting story for this year. Platinum's been somewhat down the doldrums the last few years in the function of the lack of or decreasing demand from the diesel vehicle sector, and auto companies favoring palladium while the price was cheaper. But I think those dynamics are really starting to switch, and so it could be a really interesting year. One thing I'll just add, which again is really important for people to know, is given the majority of platinum comes from South Africa, one of the reasons why analysts are forecasting such a deficit this year is because there are huge power issues in South Africa. So the state power company Eskom is distributing as much power this year as they did 21 years ago. In other words, there are blackouts that are happening on a very frequent basis. And clearly, if you're a mining company and there's a blackout, guess what? You can't produce. And so that again is affecting, production for these particular metals, and as a bullish factor whenever we've seen these sort of episodes in the past of big power cuts happening in South Africa. Typically that's been a positive for the underlying metal. So definitely something to keep an eye on. But I think the big picture here is that platinum is, I think, for the first time in a number of years, in a really good spot.
Very detailed breakdown. This is the answer I've been seeking for a long time. I've spoken to a lot of people about platinum. I've never gotten a detailed answer about why it makes sense. So thank you for that. That was awesome. I do want to shift to a product you have at GraniteShares, which is single stock ETFs based around big cap tech names. This caught me off guard when I was looking at your website because I want to say normally, but pretty much across the board, the people I speak to who are bullish on commodities are bearish on the big tech names and think that they're all due for a deep correction. And, there's going to be this huge migration out of big cap tech into real assets. So talk to us about the blue chip tech stocks, and do you think they can continue to outperform from here?
Yeah, I mean, in terms of our business, Jesse, I mean, we're an asset manager, so we're a product first company, which means that we have to design products that people want. And from that perspective, we have to be somewhat agnostic about, what those products are. I mean, clearly we offer products that we think make sense for people. But in the same way that we offer individual access to gold or to platinum, we have also come up with this new concept, which is leveraged single stock. We've been doing this in Europe for a number of years. So bringing the concept now to the US, where you can get leverage on a single company in an ETF. They've been very, very popular. So in terms of leverage to the large companies, I think the challenge at the moment, really for investors, is, again, I do believe that at some level, for the stock market, all roads have to come back to growth. And ultimately forward earnings are the most important thing to drive stocks. And those earnings, have been relatively robust across the board. And that's why we are in an environment where we see the S&P at, 4,300 or whatever at the moment. We could not be in that situation without earnings being as strong as they are. And again, going back to the large cap tech, those are the biggest companies that we have in the market, and therefore they're going to represent the biggest share of earnings in the market. So if those earnings are good, all things being equal, that's going to affect the market. Now, I personally believe that those companies, we're talking about business that have some cases outright monopolies, depending on where you classify it, but certainly monopolistic type positions, or let's just say dominance in their respective sectors. And those companies have typically been able to demonstrate growing revenue and earnings over time. And I'm not sure that there's really a strong case to say that that's going to change anytime soon. Like anything, they get affected by, in the case of last year, by rising interest rates, which reprices the earnings multiples. And maybe fears of recession clearly will impact businesses that rely more on advertising revenue. But to a large extent, NVIDIA, which has been, one of the poster child stocks for this year, and we have a, leveraged NVIDIA ETF, NVDL. That's all about AI, and AI is this kind of a new, investment phenomenon. Certainly in my career, I can't think of an event. Maybe the closest thing I can think of is a couple of years ago with crypto, where you couldn't go to an event, a conference, a webinar without somebody talking about crypto. That's all gone now, and that's largely been replaced by AI. And if AI is the story of this moment, of this year, then NVIDIA really is the stock for that. And so you get a huge amount of interest in NVIDIA on that basis. And then the other companies, again, really what we offer is a trading vehicle that allow people to take high conviction views on those particular stocks. But I think, again, it comes back to my sort of thesis that I think the economy is in better shape than people think. I think people are way too bearish for right now. And most of the metrics that I look at, I think I can't really see what the catalyst could be, other than a policy mistake or some shock that we don't yet, or we can't foresee, that things are good. I mean, I have to look at the banking crisis, and although I'm definitely not saying that we are out of the woods, I've been amazed at how resilient the market has been. I think that's one of the things that I would point to in terms of a demonstration of strength. That Silicon Valley Bank, was the 18th largest bank in the U.S. This is not some tiny, insignificant enterprise. This was a very large bank, and for that to go out of business, plus the failures that we saw at Signature, the rescue of First Republic, and so on and so forth, I think for us to be in a situation where the market has sort of absorbed that and carried on higher, to me is a very, very strong thing. And so again, I come back to, I think things are better than people give them credit for. It's not to say that they can't get worse, but for the moment, I think things are okay.
I want to end on some more general investment the direction for people, because obviously you have a ton of experience, and we like to try to give some actionable information on this show. So what I want to ask is, what do you see as the main mistakes retail investors make, and how can they correct them?
Off the top of my head, I think there's two things. And the first one is just one from my business that I see all the time. And it's people not understanding, what they're investing in, or not asking questions. So the first thing is, like you would do in anything in life, do your research, really understand what you're investing in, whether it's a fund, whether it's a company, really understand that before you make that investment. Try to understand what the drivers are, and how obviously you can do that. And clearly, the answer to what they can do more is simply to do more research. Just take the time to do that. I think the second thing that people do is they can be guilty, and this is everybody, by the way. This is professional investors as well. This is not just retail investors. Professional investors are just as guilty of doing this. This idea of fear of missing out, and latching on to fads or trends, the latest kind of hot thing in the market, without again necessarily thinking through the thesis. And one of the best examples of that is the meme stock craze that happened over the last few years, and to a lesser extent the cryptocurrency craze as well, where it wasn't just Bitcoin, but people plowed into all sorts of coins that were clearly marketed, in the case of Doge and others, as just a joke. But yet people got in, and I guess if you got the timing right, you made some money, but I'm sure the vast majority of people lost a lot of money. So I think those are the two things that just come up time and time again. That do your research, understand what you're buying, and try not to get caught up in sort of the latest and greatest fad that people are jumping on, especially if you don't understand it.
Absolutely, that makes perfect sense. Thanks so much for joining us today, William. Before I let you go, for those who want to learn more, could you fill us in on GraniteShares, and also anywhere else you want to direct people online? Feel free.
Sure. So as you mentioned, we're a asset manager. We're based in New York City. We specialize in a number of different ETF strategies, everything from commodities to individual single stock ETFs. And our website is graniteshares.com. You can have a look at our offerings there. Of course, feel free to ask any questions. Talk to us directly. We're very approachable. But the best place of information is to go to the website, have a look at what we offer, and see if there's anything that makes sense for you.
Great. Well, I'll put a link in the description to GraniteShares. Thanks once again for joining us, William, and sharing your knowledge with our audience.
No problem. It's been a pleasure. Thank you for having me.